Yes, happy evening, people. So, hope you're all doing good. So, in this session, we'll be covering a consolidated financial statement wala question that came in November 2023 wala paper. I think it came for around 14 marks. It came for around 20 marks. Probably it's an old syllabus one. Na? So, yeah, that question. So, good question. So, I would like to run you through that particular question in this particular session. So, balance sheets of Hammer Limited and its subsidiary Sleek Limited as on 31st March 2023 is given to you. Okay, a simple balance sheet. The share capital of Sleek Limited is 5 lakh. Each share ka face value is 10. So, they totally have 50,000 shares. Great. This is okay. We have two components in other equity, general reserve and retained earnings. That's okay. Now, keep this in mind. Subsidiary company totally has 50,000 shares. Now, Hammer Limited, the parent, they acquired 20,000 shares on Sleek on 1st April. So totally subsidiary company has 50,000 shares. In this, parent acquired 20. So if you do 20 divided by 50, you're going to get 40%. With 40%, will you get control? No, it has to be more than 50%. Okay, that means what? So it's a step acquisition wala scenario. So meaning multiple times investment will be purchased. So on 1st April, we purchased 20,000 shares at a cost of 2,40,000. So is 1st April 2022 the date of control? No, we have not got control yet. So it is not. And further, it acquired 17,500 shares. First they had bought 20, now they bought additional 17,500. So total will be 37,500. Subsidiary company has totally 50, in that parent has purchased 37,500, means now the shareholding percentage will become 75%. So NCA will become your 25%, correct? So when did they buy this 17,500 shares? They purchased on 1st October. So 1st October is your date of control. So this is a step acquisition wala scenario. So on 1st October shares, they purchased by paying 190 to 500. So this we know, whenever there is a step acquisition scenario, we have to take what, sir? If you already have some investment, we already have this 40% investment, no? These shares, we have to take what? At fair value, right? We can't take 2,40,000 for our goodwill calculation. For goodwill calculation, we need PC, no? So on the date of control, how much you paid, that is your PC, that's fine. This 2,40,000 was paid much before. Hence, we take on the date of control, what is the fair value of existing investment we have to take. And any some gain loss will come. Maybe the fair value could be more than 240. If it is more than 240, it's a gain. If it is less than 240, it's a loss. That since parent has acquired this, it will be adjusted off. That gain loss will be transferred off to retained earnings. And moreover, here you could say that significant influence has been lost also. Because we had 40%. On 1st April, we had 40%. Now on 1st October, we moved to 70%, 75% rather. So at 40, when you had 40%, we had significant influence, meaning we had SI. Now at 75%, we have control. So that means significant influence has been lost and control we have obtained. So this, whenever this happens, we have to account gain or loss. This only is your gain or loss. Okay, 240, the investment, you compare it with the fair value of that on the date of control, and that if it is more than 240, it's a gain. Less than 240, it's a loss. That is one. That's what I written over here. And same thing. Okay. 8% debentures of Sleek Limited includes debentures held by Hammer. No, so parent company, not only they purchased equity shares of subsidiary company, they purchased debentures also. This is mutual owings. But the problem is debenture when parent purchases, it's a financial asset. Maybe it's valued under FAT OCI method or ACM method. But when subsidiary company accounts this, for them it's a financial liability. Maybe parent is accounting under FAT OCI method because their intention is satisfied. Their business model is satisfied both by holding and selling. If that is the case, means they will value it under FAT OCI. Subsidiary company ka maybe their intention will be following FAT. They might be following ACM method for their debentures. So the value may not match. We don't. Yes, no. So that's what they're saying over here. The debentures of Sleek Limited includes debenture held by Hammer at a nominal value of 35,000. So the face value is 35,000. These debentures were acquired by Hammer on 1st January 2022 at a cost of 84. So Hammer is showing it at 84,000. Subsidiary company is probably showing it at 35,000. So they will follow ACM method, no sir. Sir, they have not given any data for us to do ACM. For ACM, we need effective interest, redemption value, what is the term, etc., etc. They need to give. If they don't give anything, they'll assume, if they give you only this much data, they'll assume that subsidiary company is showing their debentures at 35,000 itself. We don't know, lack of information. Okay, parent is showing it at 84, subsidiary is showing it at 35. But these are mutual owings, no? For one company, it's a financial liability. For another company, it's a financial asset. So it'll get netted off. Okay. But the problem is the value is shown as different. So the balance will be transferred off to retained earnings. So the entry you have to pass is debenture you need to cancel. So 8% financial liability debentures will be debited. Okay. Debenture is shown at 35. So you'll debit at 35. You have to cancel financial asset 8% debentures. For another company, it is a financial asset. No. How much are they showing it at? 84. So this journal entry is not matching. So the balancing figure, you will debit retained earnings. Okay. This is arrived as a balancing figure. That is calculated here to be difference is 49,000. This entry ka effect we need to give. Okay. So when you prepare retained earnings, because parent has purchased this investment, no? So when parent purchases, when you do other equity working note for parent, this 49,000 retained earnings should be debited. So we have to reduce this 49,000 in other equity working note. Keep this in mind. We'll see this later. The retained earnings balance of Sleek Limited subsidiary had a credit balance of 75,000 on 1st April. So 1st April is not the date of control. Date of control is 1st October. So on 1st April, that is at the year beginning now, that balance is 75,000. Okay, this is retained earnings. Similarly, general reserve ka opening balance on the same day was 50,000. This is not pre, correct? No, because the pre-acquisition means those other equity balance existing on the date of control. Date of control is 1st October. This is 1st April ka balance they have given. So we can't take this only as pre. There are additional also. Till October, whatever reserves and surplus the subsidiary company had, those are all pre-acquisition only. So keep that in mind. We'll see the working later on once we'll quickly read off the adjustment. Sleek Limited had paid a dividend at 10% on its paid up capital out of the balance of retained earnings on 1st April. So they utilized opening balance of retained earnings and paid the dividend. So we got control 6 months later, 6 or 7 months later. That is on 1st October. 1st October. 6 months later, parent has got the control. But they used retained earnings for opening balance and paid the dividend. So this is a pre-acquisition dividend. We have done such question in our regular question. DEF for the Rama, Krishna, some 2 questions was there. We have done that. Yes. Okay. The entire dividend received by Hammer was credited in its SPL account. So they have transferred this to SPL. Great. As per the resolution dated 28 February 2023, Sleek had allotted. Subsidiary has given some bonus shares, 1 for every 10. Subsidiary company ka share capital is how much? Their share capital, where is it? Here, 5 lakh rupees. For 10 shares, they are giving 1 bonus. So 5 lakh, it will be 5 lakh divided by 10. The value will be 50,000. So basically, they are giving 50,000 worth of bonus shares. Okay, fine. And this is given out of general reserve. The accounting effect has not been given. We'll see. Usually, general reserve has no impact on your accounting because share capital balance will increase. General reserve balance will reduce. But if by chance, if it is given out of pre-acquisition reserve, then it will pre-acquisition reserve we use it for net asset calculation. No? Then it will have an impact. We'll see. We'll figure that out. There is a one hidden adjustment here, which I'll talk about it. Trade receivables of Hammer includes bill receivable of 2 lakh drawn upon Sleek. For Hammer, it's a trade receivable 2 lakh. For Sleek, it will be bills payable. Trade payable rather. Value is 2 lakh. But hang on. Out of this bill, 50,000 of the bill has been discounted with the bank. So mutual owings means what, sir? The parent has to pay subsidiary company or subsidiary has to pay parent means, or one has to pay the other means, then we call such transaction as mutual owings. Here, one company is showing bills, subsidiary company, that is what here Sleek Limited is showing trade payable at 2 lakh rupees. But the parent company Hammer, for them the trade receivable is not 2 lakh. Why? So out of this 2 lakh, 50,000 bill, no, they endorsed it with the bank. Endorsement means they gave the bill to the bank and collected the money. That means the trade receivable for H Limited is not 2 lakh, it is only 1,50,000. That means what? Will you cancel 2 lakh? No. Mutual owing means how much subsidiary has to pay holding, or holding has to pay, or parent has to pay subsidiary company. Correct? No. But here 2 lakh rupees now, out of this 2 lakh, subsidiary company has to pay 150 to the parent and 50,000 to the banker because banker has that bill. So mutual owings is not 2 lakh here, it is 1,50,000. Okay, that is one hidden adjustment over here. Okay, all this adjustment was there actually in a CA intermediate AS21 consolidation question that they have also incorporated here. So hidden adjustment is no, it's not 2 lakh, mutual owings is only 1,50,000 because 50,000 bill is not with the parent, it has been endorsed and it is with the banker. So subsidiary has to pay that 50,000 to the banker. If any amount subsidiary has to pay to the bank, that is not mutual owings. Hence, mutual owings is only 2 lakh minus 50,000, which is 1,50,000. That is one. So eliminate this both from trade receivable and trade payable, reduce 1,50,000 in consolidated balance sheet. Now, during the financial year, Hammer, the parent company, they purchased goods from Sleek. So subsidiary company has sold the goods to parent. So it is an upstream sale. Yeah, 25,000 at a selling price of 30,000. So 25 worth of goods is being sold for 30,000. So 5,000 rupees is the profit. Correct? That we will eliminate. So now when we say unrealized profit, it is a profit element included in closing stock. If 100% of these goods, if it is lying as unsold in inventory, we will eliminate 100% of profit. For 100% of the goods, the profit is 5,000. Correct? But is 100% of the goods lying at parent ka go down because they purchased? No. They're saying only 40% of these goods remain. So unrealized profit is only how much? 5,000 ka 40%, which will be 2,000 rupees is unrealized profit. And subsidiary made this profit. So from when you analyze all this as during the year, no? So when you prepare subsidiary company ka post acquisition reserve ka working note, when you prepare this 2000 you have to eliminate because it's unrealized profit. Because for consolidation perspective, parent and subsidiary, you're treating them as one. So if you show all this profit, then it looks like you made a profit from yourself. Hence, or this we call it as unrealized profit. Here we need to eliminate. This is one effect. And this parent is showing the inventory. Since sale was happened not at cost price but including profit, parent is showing the inventory including profit. So this 2000 rupees unrealized profit is subsidiary company made, and it is also included, that we eliminated anyway. And this profit is also included in parent ka closing stock. So when you prepare balance sheet, you will show inventory of the parent. From inventory of the parent, we have to reduce stock reserve or unrealized profit of 2000 rupees. That is another impact. On 1st October 2022, during the year on the date of control, machinery of Sleek Limited, subsidiary company, was overvalued. Was overvalued by 20,000. That means this is a fair value adjustment on the date of control. Fair value adjustment ka increase no, they're saying overvalued. That means compared to carrying amount, fair value is less by how much? 20,000 rupees, for which necessary adjustments are to be made. Okay, so this is the fair value decrease. So depreciation rate they've given it to be. Depreciation is charged at the rate of 10% per annum. I feel there is a small problem in this adjustment, but anyways, I'll tell you what my viewpoint is this on this. The parent company Hammer has adopted an accounting policy to measure NCI at fair value, not PSL, fair value. Okay. Quoted market price by applying Ind AS 103. So we'll take the quoted market price to find out fair value. So NCA is a shareholder in subsidiary company, no? So we need, they're saying you have to use quoted market price. That means we need the quoted market price of subsidiary company on the date of control. It is given. Assume the fair value per equity shares of subsidiary company on the date of control is 11 rupees. That they've given. Okay, this 11 rupees we needed to find out fair value of existing investment. There's a step acquisition that also we will use, and to find out NCA value also we will use this. You are required to prepare consolidated balance sheet. Okay. So since there is a fair value adjustment, usually we prepare working notes. Now our working notes order is like this: shareholding percentage is required, fair value adjustments, then net assets on the date of control, goodwill, then analysis of post acquisition profit of subsidiary, NCI, and then other equity, and if required any other working note. Here maybe one extra working note, you can put it for unrealized profit, etc., etc. Then consolidated balance sheet. Okay, first shareholding percentage is pretty straightforward. We have put it up there. If you want, you can put up a working note. I've showed it there only. I've not done here. You can do it. Since we have fair value adjustment, sir, I have tried to solve the same fair value adjustment as like DEF. We have two questions in our ICA study material only. DEF and Krishna Rama, something like that. Okay, there we used to solve this revaluation adjustment or fair value adjustments like this. Now, going back, first I'll tell you what ICA is done. In my view, there is a small problem over here. But anyways, I'll tell you what to do for exam also. Now, is there any fair value adjustment? Yes, there is a fair value decrease by 20,000. What's the depreciation rate? 10%. 10% is already charged because we are preparing consolidated financial statement at the end of the year. Now come back. Oh, which PP is that? Machinery. So do you have any machinery? Yeah, this is a fair value adjustment and all is relevant for subsidiary company. No? So machinery of subsidiary company is 1,25,000. This is our year-end balance. So 10% depreciation is already charged. That means this 1,25,000 represents 90%. For 100%, before depreciation, how much will be the value? 1,25,000 into 100 divided by 90. If you do, you'll get 138,889. This is what we used to do with that DEF and all problem. Yes, sir. If you remember, correct? Yeah. Then, so we need, when we say fair value adjustment, we compare carrying amount with fair value on the date of control. 1st April is not the date of control. Date of control is 1st October. So April, May, June, July, August, September. 6 months is already over. So deduct depreciation. 1st October only. Let's confirm that. 1st October only is the date of control. Yeah, that means 6 months. So reduce depreciation for 6 months. 10% is the rate for whole year. For 10%, 6 months it will be 10% into 6 by 12. Okay, 1,25,000 into 10% into 6 by 12. If you do 1,25,000 into 10% into 6 by 12, my calculator, right? 1 minute. In fact, 138. 138,889 into 10% into 6 by 12 will give us 6,944. There's a depreciation. After depreciation, you will get the carrying amount at 1st October. 138 minus 6,944. If you do 131, you will get. Now they are saying the fair value there is a reduction, right? If fair value it's overvalued by 20 means, do you think fair value will be 131? No, fair value will be lesser than carrying amount by 20,000 because question is saying it is overvalued by 20,000. So carrying amount is more compared to fair value by 20. So fair value will be 20,000 lesser than that. So that difference is 20,000. Okay, there is absolutely no problem. Yes. No? So this is a fair value decrease. I have no issues with that. But with respect to additional depreciation, I have a small problem. Okay. Now, sir, what ICA has assumed is they've done directly. What their assumption is, okay. Normally you tell me what should be done. Now you have calculated depreciation only for 6 months. Next 6 months also you have to calculate. Next 6 months, what will be the depreciation? Same, you take 1,38,889. So because depreciation for first 6 months is 6944 means next 6 months also it will be 6944 only. Correct? This is what subsidiary has charged. Correct? Correct. But we don't take carrying amount for India's 110 valuation. We take fair value. Right now the fair value has become 11. For first 6 months, there's absolutely no problem. Depreciation charged also should be 6944. It is charged 6944. Absolutely no issues. But for next 6 months, subsidiary company has charged 6944 because from 131,945, if you reduce 6944, then only you will get 1,25,000. Okay, if you want, you can just check 131,945 minus 69,545. You can take for round off error, you will get 1,25,000. That is the value. 125 is the value of PP as shown by the subsidiary here. Correct, sir? Or that is one. I'll tell you how I got this 6597. Ignore that for the time being. Now, since we are considering fair value for our calculation, consolidation or business combination adjustment, so for the next 6 months when you calculate depreciation, for consolidation purpose, what will you do? You will take the value will not be 131, you will take it as 111,945. 111,945 into 10%, the rate, we are calculating only for 6 months, so into 6 by 12 if you do, you will get 5597. So this is basically 1 lakh, 1 second. I'll just show you how we calculate. 1,09,45 into 10% into 6 by 12. If you do that, you will get 5597. This is the depreciation to be charged for the next 6 months. Okay, fine, people. Okay, but subsidiary has charged how much? 6944. That means what? To be charged depreciation for consolidation purpose is only 5597, but they have charged 6944. So it should be 5597 minus 6944. So it is what, sir? Since there is a fair value decrease, you will not get additional depreciation. You will get reversal of depreciation. How much? These two are difference you have to calculate. If you calculate, you will get 1347. So in my view, reversal of depreciation should have been 1347. Okay, in my view. Okay, that's how they've solved DEF problem and one more problem, and I feel that is right. That's the way it is done also, correct? Now, because all the numbers are matching. So, because 131,945 minus 6944 or 5545 if you do, you'll get 125, correct? Now, so in my opinion, reversal of depreciation should have been 1347. But you know what? Study material has assumed they've calculated depreciation like this. So, this is the same 5597. Now, next 6 months ka depreciation, they've taken it as 6597. How? 131, this number is there, no? 131,945 you take, okay, into 10% for 6 months you calculate. 131,945 into 10% for 6 months if you calculate, you will get 6597. They have calculated on this, which is wrong, correct? No, because even if you take that, see 131,945 minus 6597 if you do, you are not getting 125, you are getting 125,348. So in my view, that is wrong. So this is not the depreciation charged. Okay, so they have taken reversal of depreciation to be 1000. I'll tell you one quick short way. You don't have to do all this. Okay. But I'm telling you what ICA has done and what is my view in this point. Okay, so they have taken the depreciation as 6597. They have assumed that subsidiary has charged for next 6 months 6597. Depreciation to be charged is 5597. This there is no problem. And this difference is 1000 rupees. So they have taken reversal of depreciation, not 1347, but they have taken 1000 rupees. In my view, that is slightly wrong. Okay, so in exam, what to do? So I am nobody. Right? Ultimately, what our mother body says. That is the ultimate thing you need to do. So how will we remember? So one problem they've done like this way, one other problem they've done it like that. So one quick formula you can remember for easier sake, for examination sake is simple. So apply this way. This is the backward working. Okay, because the carrying amount on 1st April they're not given. You use this when the fair value is not given to you in the question. I mean, when fair value is directly given to you in the question. If you refer the DA wala problem and all, they had only told the fair value of plant and machinery is 1,11,945 or 2 lakh. Like this, the fair value of the respective assets on the date of control was clearly given to you, mentioned to you in the question. So if they give you the fair value of respective assets on the date of control, you do the working like this and calculate. Okay. But in this problem, check, have they given the fair value of that particular asset? No, they directly told it is overvalued by 20,000. So this is not fair value. This is the fair value adjustment. So this is the fair value adjustment as what? Increase or decrease? This is fair value adjustments on the date of control is 20,000. So when they give you the fair value adjustments on the date of control directly in the question, this is a quick fix. My view is still it should be done like this only. Okay, but I'm telling you how to tackle this in examination so that you don't end up losing the marks. Okay. So when they give you fair value adjustment here refers to increase or decrease. Could be anything. Here it's a decrease, right? Fair value decrease directly on the date of control if they're given to you in the question. Then calculate additional depreciation or reversal of depreciation directly on what? This fair value adjustment itself. Okay, how? So now this is the fair value decrease, no? Right? That means you are reducing the value of the asset. but subsidiary has charged higher depreciation because all this, the reduction is a consolidation adjustment. Subsidiary has not done this. They have charged higher depreciation. So you need to reverse. How? So this fair value adjustment is 20,000. What is the depreciation rate? 10%. Directly take 20,000, multiply 10%, and the date of control is 1st October and year is ending on 31st March. So from 1st October to 31st March, if you count, at least 6 months. So like this, directly you calculate 20,000 into 10% into 6 by 12, which is 1,000. So the net impact is 19,000. So ICI is doing this particular method. I slightly disagree with that, but follow this only for examination. Do not follow this. You might end up losing the marks. But in my view, this what I've done is right. I just wanted to put that across. That's all. Okay, sir. Follow this only in examination. I think I've made it clear how you need to apply which method. Okay, once again, I'll quickly tell you. If fair value itself, not fair value adjustment, fair value itself is directly given to you in the question, then you put up this backward working if necessary, like the way we used to do in that DEF wala problem. If fair value adjustment is given to you in the question, when we say fair value adjustment, it is either increase or decrease. Then take that fair value increase or decrease itself and then calculate additional depreciation or reversal of depreciation depending on what case that is. Here it's a fair value decrease, so you will get reversal of depreciation. Okay, why 6 months? Because from 1st October to 31st March. Like this. This is 1/3. Okay, this is a little controversial according to me. Point number 1. Okay, sir. Alright. Once this is done, then we can calculate net assets on the date of control. How do you get net assets? Share capital and other equity. So subsidiary company ka share capital was how much? Where is ArP here? 5 lakh rupees. Okay. This is one. All right. Next. Then we have two reserves, general reserve and P&L. Have they given? Yeah, sir. Date of control is 1st October. They have given general reserve ka and retained earnings ka balance on 1st April. 1st April is not date of control. Date of control is 1st October. That means this is opening balance. So opening balance of retained earnings is also pre only because it is already existing. So opening, first maybe we'll do general reserve. Opening balance of general reserve is, where is it? Here. 50,000 rupees. Okay, now there's a small point I would like to bring in. This is with respect to general reserve. Opening balance and closing balance. Opening balance as given in the question is 50. Closing balance you will find it in the balance sheet. Check. Subsidiary company ka balance sheet value of general reserve is 1,25,000. Okay, sir, opening balance, that is on 1st April, the balance was 50, closing balance has become 125. So that means during the year it has increased. Increased during the year. How much is the increase during the year? 50 has become 125, means the increase during the year is 75. Obviously, the 75,000 would have got transferred from retained earnings to general reserve. That's the reason. General reserve balance is increased. That's fine. Now, this 50,000 is definitely pre because this is 1st April ka balance. What about this 75,000? Sir, this 75,000 has both. Why? Sir, the increase has happened from 1st April to 31st March. That means this increase is for 12 months. But date of control is 1st October. That means April, May, June, July, August, September. 6 months. 6 months of this figure is pre, 6 months is post. Correct? Yes. So if you do that, 75,000 into 6 by 12 or divided by 2, if you do, you get 37,500. So this is 37,500. This is 37,500. So that means the total pre will be how much? Opening balance is pre. The increase during the year for 6 months is also pre. So the total pre will be 87,500. Okay, that's what I've written here. 50 pre, 37,500 pre. Manageable. Done, sir. Okay. Now the point is, using general reserve, did you give any bonus? Yeah, we'll read that point once again. What is that? Sir, where is it? Here. As per the resolution on 28th February, Sleek Limited allotted bonus shares of 1 for every 10 shares held. So that means what is the value of bonus shares? For 10 shares, they're giving 1 as bonus. Subsidiary company has a share capital of 5 lakhs. So 5 lakh, how much it will be? 5 lakh divided by 10, which will be 5 lakh is the value. So that means this 50,000 is also the value of bonus shares. So subsidiary company wants to give 50,000 worth of bonus shares using what? General reserve. The accounting effect has not been given is what they're trying to say. Bonus shares. So if they have given this bonus out of post-acquisition profit, it has absolutely no problem because share capital will increase and then retained earnings will increase. So it is, retained earnings will reduce, share capital will increase. So it's okay, right? But the problem, one small hidden adjustment here is, so post-acquisition general reserve is only 37,500. But for bonus, just now we calculated, we need 50,000. Okay, do we have 50,000 balance in post-acquisition general reserve? No. That means you'll have to assume. So whenever there comes an assumption, right, there will be a little controversy. What is that? So you can make various assumptions. What is that? One, you can assume that entire 50,000 was given out of only pre-acquisition general reserve, which is valid. Second assumption you can make is 37,500 out of this 50,000 bonus, 37,500 was used out of post-acquisition general reserve. Balance, 37,500 minus 50,000 if you do 12,500. For that we used pre. Or another student can assume 50% pre was used, 50% post was used. Another student can assume 80% pre was used, 20% post was used. Like this, you can make any assumption because lack of data, everything is right. Now, if a student assumes different assumptions like this 50-50, 80-20 or entirely pre, okay, then how will the marks be awarded? Because there are endless combinations. Even 50-50% is correct, 80-20 is correct, 60-40 is right, correct. So that means invigilator, the person who corrects your paper, is definitely a chartered accountant, but he's not an FR teacher, correct? No. So right, that means if the student assumes 50-50, if that 50-50 percentage, if it is not mentioned in suggested answer, do you think that student will get the marks? No. Obviously, his marks will be taken away because invigilator may not be aware of everything, right? Of all this. They will check what suggested answer, compare student's answer and give the marks. So this is where little controversial. So these sort of things, not adjustment, ideally in examination paper, you should not give such things. Okay. So it is, in my view, that means directly you should not give it in exam, at least give it in RTP. Just to give an idea that what assumption ICA is making and then put it up. So that means students also probably, if they've done that RTP, they'll make the same assumption. Directly, if you give it off an examination question where there are multiple options here, then it becomes very, very difficult, right? No, because students may end up losing the marks, which is according to me not more appropriate. And moreover, it is, see, I mean, all this also may not make logical sense. If 28th February, if you have issued bonus, why will the accounting effect not be given, sir? Right? Year will end on 31st March, right? So obviously, in 1 month before the year has ended means which company will not account bonus shares, you tell me. So is that practical? So for the sake of adjustments, you are making some adjustments that too controversial and directly give it an examination paper. That puts students' position as in a very tricky position. According to me, all this should not be avoided. Simply they could have avoided all this. Okay. In my view, that was the best thing. Okay. But anyways, now what does ICA assume? Tell that. No. So at least next attempt we'll make the same assumption. Now ICA has assumed that entire 50,000 bonus. Since there is a shortage in post-acquisition general reserve, ICA has assumed that this 50,000 we have utilized pre-acquisition. Pre-acquisition general reserve has been utilized to give bonus shares. That is what ICA has assumed. Why? Because post-acquisition balance is not sufficient. That is the assumption they have made. But I would suggest make the same assumption in examination. You never know what it is. Okay, that means what, sir? Is the pre-acquisition general reserve 87,500? No, out of this 50,000 was utilized. No. But we can't add share capital to this because the share capital is not increased by 50,000 bonus shares on the date of control. Okay, so you have to reduce 50,000 due from the pre-acquisition general reserve due to the bonus element. We are making this assumption only because post-acquisition general reserve is we don't have enough balance. Hence, pre-acquisition general reserve has been utilized to give away general reserve. Hence, we minus. Okay, na, sir. That means the general reserve balance will become pre-acquisition general reserve balance will become 37,500. This is one. Make the same assumption and do the same way in examination because we don't want to kind of put ourselves in tricky position when it comes to marks. Okay, let's do the same thing. But according to me, many other assumptions are also acceptable in this view, but don't do it in examination just that. Okay. So now we are doing net assets. So we got share capital, we got general reserve. Then any other reserves is there? Yes, we have retained earnings. Have they given retained earnings? Yeah, they've given retained earnings ka opening balance on 1st April. How much is that? Where is that? Here, 75,000. Opening is 75,000. Closing balance is no, subsidiary company ka 250. 75 has become 250. So I've just drawn up a ledger over here for your reference. Okay, 75 is the opening balance. If you want, we don't do these ledgers and all. Just for your easy reference, I prepared P&L, or you can call it as retained earnings ka ledger. Opening 75, closing 2,50,000. Why you prepared ledger? Because there is one adjustment. What is that? Dividend. Has subsidiary company declared any dividend? Yes. They declared a dividend of 10% on its paid up capital. What is that paid up capital? The paid up capital was 5 lakh. Dividend rate is 10%. So when you pay dividend, retained earnings balance will reduce. Yes. So how much is that? 50,000 rupees is the dividend. 5 lakh ka 10% basically. 5 lakh is the share capital. The dividend is 10%. So dividend is paid off. So to dividend 50,000, then dividend account debit to bank account 50,000 will pass. Correct, sir? All right. Then opening balance is given, closing balance is given, dividend data is also given. So balance is not matching. The balancing figure is nothing but your current year profit. You are raising as balancing figure. It's common sense also. You had 75 opening balance. From that you paid off because they used opening balance of general P&L to pay dividend. That's what they told. From 75 they used off 50,000. That means the balance opening balance available is only 25. But from 75 may say they used 50. So opening balance of profit available is only 25. But closing balance is 250. From 25 it became 250. That means 2,25,000 is the profit made by subsidiary company during the current year, meaning this is 12 months ka profit. All right, same drama we need to work out here then. Opening balance of general reserve is on 1st April. Date of control is 1st October. So opening balance of your retained earnings is entirely pre. Then current year profit. From April to 30th September, you acquired the shares on 1st October, no? That means the first 6 months ka profit is pre, next 6 months ka profit is post. Total profit for the whole year is 225. For 6 months, it will be half. So it will be 1,12,500. So current year first 6 months profit is pre. So adding these two, your total pre-acquisition profit or retained earnings will be 187,500. Okay, G. Yes, this is done. Then do you have any fair value adjustments? Yes. Here we have a fair value decrease of how much? Here only they told 20,000. It's not increase. It's overvalued. So fair value adjustments is negative over here. You have to reduce the asset ka value. Hence net asset balance will reduce. If asset balance if you reduce, net asset balance also will reduce. Hence fair value adjustment minus here. No other reserves we have. So net assets on the date of control is 7,05,000. Failure good, sir. Work is. Once you know net assets, you can find out goodwill. PC. How much is PC? So we have 2 PC. It's a step acquisition. On the day you got control, how many shares you acquired? 17,500. How much did you pay? 192,500. So all these are fair value exercise. This 17,500 you purchased on the date of control itself. So this 192,500 is already on fair value terms. So take this. So this is your carrying amount of the investments on the PC paid on the date of control. Okay, sir. But you already had some investment. No. Yeah. On 1st April only you had purchased some 20,000 shares. That we have to take what? For that you had paid 2,40,000. But that value of 2,40,000 was on 1st April. We are doing the goodwill working on the date of control. Date of control is 1st October. Hence what IND AS 110 says is, if you have any existing investment already, you have to take fair value of that existing investment. How many shares we have of subsidiary? 20,000. And on the date of control, they told the fair value of one share of subsidiary is 11 rupees. Fair value of one share is given at the end to be 11 rupees. On 20,000 shares, it will be 20 into 11 will be 2,20,000. That means there is a loss here. Correct me, sir. We purchased this 20,000 shares by paying 240, but we are taking only 220. So this 20,000 is a loss, which will be adjusted with retained earnings. So if you just check here, other equity ka retained earnings, loss and significant influence, loss, I've written it as 20. I hope you got this. Yeah. Because this 20,000 shares, once again, I'll show you this 20,000 shares you acquired by paying 2,40,000. But for goodwill calculation, we are considering only 2,20,000. Okay. So these two becomes your PC. Correct. Okay, then NCI. NCI, they told you have to value under fair value. They told in the question. So a subsidiary company totally has 50,000 shares. In that, parent first acquired 20,000 shares. Then they acquired 17,500 shares. So that means the totally parent has acquired 37,500 shares. In 50,000 shares, parent has acquired 37,500 means balance is 12,500. And they told find out the fair value of NCI by keeping the market value, quoted market price. 12,500 shares NCI has, and the fair value of one share in the date of control is 11 rupees. So 12,500 into 11 if you do, you will get 1,37,500. That is the fair value of NCI on the date of control. Okay, then reduce the fair value of net assets on the date of control, which is 7,05,000. You will get the goodwill. I mean positive number goodwill, negative number bargain purchase gain or capital reserve. So here it's a case of capital reserve. They have not, I mean, obviously there is no goodwill means there is no impairment also on goodwill which arises. This is your working note number 3. Then working note number 4 for your analysis of post-acquisition profit of subsidiary company. We have general reserve and retained earnings here. So 6 months of current year profit is pre, 6 months of current year profit is post, obviously, right? So post-acquisition profit is 1,12,500, correct? Now, is there any adjustment? Excuse me. Is there any additional depreciation? No. We have fair value decrease, so we have reversal of depreciation, which we already calculated here, 1,000. You have to reverse the depreciation. Depreciation is an expense. If you are reversing an expense means and you are reversing this, all this fair value adjustment is relating to subsidiary assets. So don't show all this 1,000 depreciation adjustment in other equity of parent. Since these are subsidiary assets, it should come under post-acquisition profit of subsidiary only. Since you are reversing the depreciation, profit will increase. That is one. Then parent company sold some goods. No, or parent or subsidiary, I think. Subsidiary sold, I think. No, here. Somewhere they told, no, hammer purchase. So subsidiary company has sold the goods. We already calculated unrealized profit. So unrealized profit you need to eliminate. Since subsidiary made this profit and this is unrealized profit, eliminate from subsidiary ka post-acquisition profit. We already did this, or I've showed. You can no need to prepare a working note. Directly you can show the calculation like this. Okay, sir. Then you will get the revised post-acquisition profit of subsidiary that apportion among parent and NCI in their respective ratio, 75 and 25. Okay. Then we have general reserve also. What is post-acquisition general reserve? We already got it, which is 37,500. So post-acquisition general reserve is there. We already done some adjustment. Bonus and all is already over. So this post-acquisition general reserve distribute among parent and NCI in their respective shareholding percentage of 75-25. This is working note number 4. Then working note number 5 for NCI. NCI on the date of control. Okay, already we know the fair value of NCI on the date of control is somewhere we calculated here. No, so where is that? Fair value on the NCI on the date of control is 137,500 already calculated. Then NCI will ask for their share of post-acquisition retained earnings, post-acquisition general reserve. We got the previous working note added. Then, so one adjustment we used to do it in the DEF wala problem. Here, has subsidiary company declared the dividend? Yes. Is that dividend declared out of pre-acquisition profit or post-acquisition? If you want to read the adjustment, the subsidiary company has declared the dividend out of the retained earnings balance on 1st April. So any balance of retained earnings on 1st April is pre. So using pre-acquisition profit, subsidiary has declared the dividend. And this only dividend only we call it as pre-acquisition dividend. Any dividend which is paid out of pre-acquisition reserves and surplus, we call it as pre-acquisition dividend. And I told you in the class for pre-acquisition dividend, reduce the pre-acquisition dividend from NCI working out and other equity from the parents retained earnings also you need to reduce. Why the logic is, sir, using pre-acquisition dividend, they have subsidiary company has declared the dividend. Okay, that means, so how do you find out net assets on the rate of control? You take where is that here? Here. You take the reserves and surplus existing on the rate of control and you calculate. Now here you took for net asset calculation retained earnings balance is 75. But using the 75, 50,000 has been given as dividend. That means the balance should be taken as only 25. But we took 75. Correct? Now that means unnecessarily net asset balance is increased. If net asset balance increases, shareholders have a share in net assets only. Who are the shareholders of subsidiary company? Parent and NCI. That means NCI share has been taken more. Hence we need to reduce is what I told. But in this problem, you should not do that. See, that's the reason I've written and I cancelled. Why? So in the DEF problem, NCI was valued under PSNA basis. NCI was valued under PSNA basis, meaning they had a proportionate share in net assets. Here, NCI is valued under PSNA basis. No, it's valued under fair value basis. That means the value of NCI is already on fair value terms. Now, if you reduce it, you will be deviating from fair value terms. Okay, because all these adjustments are on the date of control. You already taken the NCI on the fair value terms. Means this particular adjustment should not be done both here and under retained earnings. That's the reason I've written this and I've struck off. So you have to reduce this pre-acquisition dividend only if they say NCI is valued under PSNA basis, proportionate share of net asset basis. If they say fair value basis, then this particular adjustment not required. That's a differentiating factor between the DF question and this particular question. So do this plus minus, you'll get NCI on the date of reporting, which is 174,750. Okay, sir. Lastly, other equity while working note are prepared in this format. The way you present it, this is the way you should prepare the notes. So see, basically, if you want, you can change the format and put it in just 2 columns also, your choice. Okay. So opening balance of retained earnings. What is parent ka retained earnings pa? 3,50,000. General reserve ka is 2 lakh, which I have taken here. Yeah, 2 lakh and 3,50,000. Opening balance of general reserve, I've taken it as 2 lakh. Parent ka, I've taken it as not opening balance, but 3,50,000 is a profit made by the parent in the current year. Instead of total comprehensive income, TCI stands for total comprehensive income. Means you can make this 0 and you can make this as 3,50,000 also, your choice. Assumption. I've just made this assumption here. Okay, sir. Then post-acquisition profit of subsidiary company you add. We already calculated that. No? Post-acquisition share of retained earnings is 83. Post-acquisition share of general reserve is 28, 125. 83, 625 and 28, 125 we have added. Okay, Saru. Then impairment loss on goodwill. We have anything? No. So strike off that. Then we lost significant influence when we purchased the investment at 240, but we considered for goodwill calculation only 220. So there is a loss of 20. Eliminate that. That is one. And here one more thing. If you remember the debenture adjustment, we already wrote it here. We wrote the entry also. Just show you. Right? The parent had purchased some debentures of subsidiary company. Subsidiary company is showing the debenture at 35, but parent has purchased this debenture for 84. So that means for parent, it is an investment, a financial asset. For subsidiary, it's a financial liability, but the value is different. So there is a difference which we will debited retained earnings. Okay, since parent has purchased this investment, so you have to debit this retained earnings only for parent. Don't debit subsidiary retained earnings because parent has purchased this investment. So the difference in figure will only affect parent retained earnings. If you debit subsidiary retained earnings, NCI also will bear this loss. Okay, NCI has not purchased this investment. So hence this 49,000 rupees. Okay, you have to adjust only in working note number 8, which is parent retained earnings. Since you're debiting retained earnings balance will reduce by 49. Check, have they done that? Yeah, here I've reduced 49,000. There's one more adjustment. So this pre-acquisition dividend wala adjustment will not come because as I told you the logic there. Yes, sir. Then did you do 1 minute? Yeah, I think recording is going fine. Yeah. we got goodwill or we got capital reserve. We got capital reserve here, 1,55,000 that I showed it over here. Okay, then you will get the revised closing balance of all the reserves. Adding all this, you will get the other equity to be 7,47,750. Okay, sir. So I've written the comments. So if you do this right, then finally consolidated balance sheet is very, very straightforward, sir. Okay, how is that? Simple. This is parent ka PP. Okay, if you want, I can show you the question also. Parent ka is this one total will take 6 lakh and subsidiary ka 325, which we have taken. Excuse me, here. All right. Then is there any fair value adjustment? Yeah, here fair value decrease. So minus 20,000. Then reversal of depreciation 1,000. Add it. You'll get it. Okay, sir. Intangible assets, there is no goodwill. So straight away addition. Whatever balance sheet value is given, straight away add, you will get it. Okay. Then investment. Investment, you need to be a little careful. Check what is the investment of. We'll go to the balance sheet. Investment for parent is 625. Subsidiary it is 125. So 625 and 125 you take first. That we have taken. Then this 625 now includes two things. One, it includes investment in subsidiary. Parent has purchased investment in subsidiary. Can investment in subsidiary company be shown? No. And this investment in subsidiary company, parent purchased in one shot. No, they got it in two installments. First, they purchased 20,000 shares by paying 240, which is included in the 625. So minus that because it will not come in consolidated financial statement. Instead of investment only, goodwill, capital reserve and all will come. Correct? Then they purchased 17,500 shares more by paying 1,92,500 something. So that is also included minus that. That's all. No, parent purchased some debentures also. If you remember, we wrote the entry also here. Yes, parent purchased the debenture investment, which is worth 84,000. That is also included in investment for parent. That is also investment. No. So in the 625, investment made in subsidiary company ka debenture is also shown. So minus that. That's all. So balance is your other investments, which will come in your consolidated balance sheet like this. Okay, G. Next, inventory mein there is a unrealized profit of 2,000 rupees that we need to take the balance sheet value. Unrealized profit of 2,000 you minus. Rest everything asset. I think mutual owings was also there. I think trade receivables. I think mutual owings we already identified 1,50,000 was it? Somewhere we wrote the mutual owings of 1,50,000 is there. Reduce that. Okay, cash and cash equivalent, no adjustment. Share capital only parent will come. Other equity you will get it from working note. NCI you will get it from working note. So these are fine. Borrowings may need to be careful. Now where is the borrowings for? For parent it is 0. For subsidiary it is 1 lakh. But this borrowings is nothing but your debentures. Now, if you check working note number 4, that is nothing but debentures. Parent purchased some of the debentures. So that is mutual owings. What is that value of debentures? Total value of debentures for subsidiary company is 1 lakh. In that, how much face value of the debenture parent has purchased? 35,000. So 35,000 is mutual. You need to reduce that. Yes, from 1 lakh you have to, if you just check the balance sheet. 1 lakh, 0 is the parent ka borrowings. Subsidiary ka borrowings is 1 lakh. Minus 35,000 is the debenture, which is subscribed by the parent, which mutual owings eliminated. Okay, sir. Done. Bank overdraft may no adjustment, straight away addition. Trade payable, mutual owings. From debtor also you reduce 150. So from trade payable also you reduce at 150 and your balance sheet will match. That's all. Okay. So one or two adjustments, little controversial according to me. But anyways, but make the same assumptions as we have written here. Do not change that because unless ICA modifies the things, if you do slightly here and there is a chance of or there is a risk of losing some marks and we don't want that. Yes. So yes, people. Otherwise, overall a good question, I would say. Yes. So this is about this question. Hope again the session was helpful to you. Take care. See you all the very best.